let's think about balance of payment from a visual perspective. When we have two different countries, let's say USA and China, and let's say that they both want to trade with each other. We see that China has a different currency, and we know that the US also has a different currency. So how can they trade with each other, and how do we record these trading? That is essentially what balance of payment is all about. When you think about citizens, let's look at citizens. How can citizens trade with each other? Well, when you talk about two different countries, they can let's say some individuals in China wants to send money back to US, or some US citizens want to send some money in China. We would record that as transfer payments. Transfer payments we can also think about it from a perspective of remittances between two different individuals from different countries. Transfer payments, these are a little bit different from that of the government. The government also has transfer payments, but that is a different scenario. We're talking about exchange market in this situation. So we can look at it from a perspective of transfer payments or transfer accounts or remittances. They all essentially mean the same thing, which is two different citizens from two different countries trying to trade with each others across borders. We can also look at it from a perspective of firms. How can the firms trade with each other? Well, the firms can buy assets or they can sell assets from each other. We can call that change of assets. Change of assets. We can call that change of assets, or buying and selling of assets. We know that the individuals from US can buy stuff from companies in China. We would call that as imports. Companies in China are importing goods and services back to US. Well, firms from US can also export. They can also export to. What about the government? What can the government do? The government's job in all of these transactions is essentially to control and handle and to make sure everything goes in a stable fashion. And they can do that by influencing the exchange rate market. Since individuals from China and firms from China will be dealing with their own currency, will be using their own currency, and firms and individuals in US will be using US dollars, we need a mechanism that can allow everyone to trade with each other in a stable and in a sensible fashion, and that is done through the exchange rate market. And the government can directly influence the exchange rate market by using their reserves. Government on both sides can use their reserves to influence the exchange market on both sides, and that is something that we will go through in the next video. In this video, I just want to focus on what balance of payment is all about. So as you can see, balance of payment essentially is about individuals and firms trading with each other, and how do we record those transactions. Balance of payment consists of two main components, which is the current account and the financial account. Current account and financial account both are autonomous, meaning the government does not directly influence both of them, and both of them are essentially, so current account is about recording exports / imports and recording transfer payments. All the transactions involving these will be recorded in the current account. In the financial account, we record mainly changing of assets or buying and selling of assets. That's another way of looking at it. Changing of assets or buying or selling of assets. So if individuals from US, let's say, buys a company or purchases some shares from a company in China, and let's say after a maturity of 1 year they earn the profits back, we will record all the money sent from, or the outflows from US as a negative, as a debit, and all the money coming into the US as a credit. We always record our transfer payment moving out of the country as a debit, and all the transfer payment coming into the country or as the inflows as a credit. Anything which is coming into the country, we will record that as an inflow, and that is recorded as a credit. When we talk about exports and imports are recorded as debit and exports are always recorded as credit. Now, why do we use these different symbols? Has to do with accountancy, and because this is not an accountancy class, we won't really go in depth into why we do that. And then we also have the third component, which is our financial reserves, and we'll talk about how the government can influence the exchange rate or the exchange rate market using the financial reserves. And of course, because we involve millions of individuals, there'll always be some errors, and for that we have another account which accounts for all the discrepancies or errors or omissions that can happen during these transactions. And the reason we call it balance of payment is because at the end they all balance out. If we take the numbers, if we take minus 470 current account deficit, if we take plus 216 current account surplus, and if we take financial reserve, add it into the financial market, into the exchange rate market, they will all add up to a zero. They will all balance out. In the next few videos, go into details of why the government gets involved and what are the possible complications that can happen and the policies we can think about it. From an accountant's perspective, it's all about recording transactions. From an economist's perspective, it's all about understanding those transactions. So for instance, we can see that in this scenario, US is importing more material than exporting, and therefore their imports are more, so they have a current account deficit. Well, what does that mean? Is it bad? Is it good? What policies can we do to fix it? What policies can we do towards it? Should we fix it? Should we make it worse? We have very different opinions across the board. We have, in this situation for America, we have a current account, a financial account surplus. Many economists argue for developed countries, they generally seem to have a current account deficit and a financial account surplus. Developing countries have the other way around. They export more, so therefore they have a current account surplus, and because they don't buy and sell assets a lot between other countries, especially buying assets, so their financial account is seen to be a deficit. Well, what does that mean? How do we understand that, and how can we implement policies to help fix that problem is something that economists deal with. In this specific in this topic, as economists, you just have to understand what is balance of payments, different components of balance of payment, and what do they account for, and what does it mean to have a current account deficit, what does it mean to have a financial account surplus or a financial account deficit.